All right. Good morning, everybody. Welcome back to the Relentless Growth Podcast with myself, Chase Calhoun, and my good friend Jack Maher. How are you doing this morning, sir?
Doing great. I'm sitting on the beach, so I couldn't be happier.
We can't see it; the screen's all blacked out. So I wish you would have faced the ocean and turned it on so we could also see it. But maybe later. I guess today we've got an exciting and I think necessary topic we're going to discuss. So we're just going to kind of go over the state of the market and state of things that we're seeing kind of in real time. But before we get into that, let's get started with maybe an update and a win. What's going on other than being somewhere nice? What's going on in your world?
Yeah, a big win. I think I've got a good buddy who does more extreme vacations than I do and takes longer and longer ones. But I think vacation is always a good test with the team you've got at home, and so I've involved myself in a couple things since I've been on vacation, but that's my own problem. I have not been involved in things. And so that's always great to have things run smoothly, not have a ton of fears or concerns when you're not there or not physically there or not connected like you normally would be. And so that's always a win for me. And so I think it just gives me confidence to be able to do stuff like this or continue to maybe a long time in the future, step aside for longer times, longer vacations, longer trips. And so that's a big win for me. Is just the team that we've got in place back at home.
That's awesome, man. Yeah, it's a weird thing that a lot of people probably can't necessarily relate to, but it's kind of stressful for me when I leave. Like
Yep.
knowing everybody's got it and like everything's going fine, and they really don't need me and all, but it causes, at least for me, some kind of stress or anxiety. Not being as in the loop, I guess, is normal. Cool. I think for me, a big kind of business win, I guess, for us in this last week is. And I think we talked a little while back about lease ups and how slow kind of leasing's been lately. We've been finally making some like awesome, leaps forward on leasing. So we're getting really close to being at our goals as far as occupancy and just making a lot of traction on leasing. So it's been kind of a cool one in the last couple of weeks to make some good progress there.
Yeah, that's great.
I think that's probably a good way to segue into what we're going to be talking about. So kind of the state of the market and maybe I'm in Central Arkansas, you're in Spring Hill, Tennessee, what we're seeing in our local markets, but also kind of what we're hearing or seeing nationwide. I know one thing we probably won't go into too much because we talked about it in depth recently, but the leasing and occupancy as far as rentals, we've seen it a lot. It's been the slowest I've ever probably seen it. And so just as far as like units sitting on market longer than normal, less inquiries, less showings, less lease ups than normal. We've been seeing some good progress with lease ups. I think more just by really like hammering on it and making it like a top priority. Not necessarily that the market's picked up that much. So I think leasing's still pretty slow. I'm still seeing a lot of vacant units. I'm also, one thing that I've since dug into a little bit more is we're seeing more delinquencies and more distress, like distressed tenants that are it's not just that they're, some of it's that they're not managing their money well, which we've always seen and something that we always experience. But some of it's just straight up that people either aren't working or they're working less than they were and they're just getting behind to the point where they can't catch up. So we're seeing a little bit of that. And one thing that very recently that we've experienced that I've never personally dealt with in the past, but I know in the construction industry, it's kind of a thing, but we've seen distressed customers where we're doing third-party construction projects for other real estate investor customers that it's almost like the tenants where like we can tell that they're distressed and they're having a hard time paying and where it's like, kind of red flags and starting to become problematic. I have never had to like threaten to enforce a contract. And in the past we were like, didn't even do contracts because we were just handshake and everybody's going to do what they say they do. But we've actually seen, just within the last week, a couple customers that are like visibly distressed where it's like they're, one of them, it may even have to go into litigation because it's just like they're not paying their bills and they got behind and it doesn't look like they're going to be able to get caught up. How about in your neck of the woods? What are you kind of seeing?
Yeah, I think A lot of similar things from like an occupancy standpoint, which again, I know we talked about last week, but I think it is important because I think it's kind of an indicator for the economy overall is
Yeah.
how we look at it a little bit because the vast majority of probably hourly workers in the country are renters. And so we have seen a little bit more distress. We've seen more evictions. We've seen more things like that lately. And then the market is just, it's slow and it's really interesting as well because especially in both of our markets, we continue to have huge population growth. And so the market is being satisfied somehow. You know what I mean? Like people are going somewhere, they're living somewhere, they're finding places. And so I think we are seeing a lot of pent up demand that I think is going to hit at some point. It's just what it takes. Does that take rate cuts? What does that take to get that demand to flow? And so we've seen the same thing by, concentrating on leasing, making that, it's not as automatic as it used to be. And so making that more of a forefront, we've seen some success there. But I think it is an indicator, like you said, you're seeing it pop up in other parts of the economy or parts of your business where people are distressed. And so, I'm not smart enough to understand macroeconomics or anything like that. But I think it's from just a simple standpoint, it's something where you wonder, is it a sign of there's more to come? Is this just like the culmination of the pressure point of the last couple of years? We've been hearing that distress is coming for basically since COVID at this point, that, hey, this big wall of distress is coming and it's going to hit and it's going to hit. And it really hasn't, at least in our area. And so, I'm not sure if that's just gotten pushed to the point where, hey, now you're starting to see bits and pieces of it. But yeah, we're seeing a lot of the same things. Thankfully, we haven't had any subcontractor or supplier issues yet with payment or things like that. But those things happen, especially in the construction industry when things get tight, when people get overextended. And a lot of times, I hate it for subcontractors because a lot of times it's not their fault. A lot of times they're doing a couple other big jobs and those guys don't pay. And then they can't order supplies or do what they need to do for your job. And then it's kind of a domino effect.
Yeah.
And so, what we have heard is some big players in our local market, anecdotal stuff, nothing major where, hey, they took 4 months to pay me, or things like that. And so we have seen even from some big players that they're not doing anything nefarious, but you know how big companies do. They'll use every trick in their tool bag to delay a payment, 30 days, 90, 120. And so we're seeing more and more of that, definitely. And so I think from our perspective, I think it's going to be interesting what the next 6 months probably tells us, because I think we all hope and think that there's rate cuts coming in the first quarter or significant rate cuts. And so if this happens, how does that change the economy? How does that improve customer confidence? How does that correlated with the multifamily supply that should be drying up because of what's been built over time and what's not being built now? So there's going to be a lot of converging factors ending out 25 and starting 26. And so I think we're optimistic that things are going to improve significantly, but we're seeing the same thing. So it's always a guessing game on whether it's going to continue or not.
Yeah, it's interesting. So like maybe shifting a little bit to the real estate kind of sales market, both residential and
Yep.
commercial. I am a little bit more plugged in with the smaller commercial, so small multifamily and residential. We deal with a lot of investors who are looking at stuff like that. I have started to see some like actual kind of distress in some of the small multifamily stuff and I think you'll probably see the same thing, just a larger scale with the larger properties, where it's like people overpaid kind of a couple years ago at the peak, and then they've been getting hammered with unexpected expenses and things popping up, and now they want to sell. The problem was, I would say a year ago, is they were wanting to sell at 2 years ago prices. So it's like they wanted to like exit at the top, even though we were already kind of like starting to see this kind of decline in some of this stuff. And then you couple that with like things like increased taxes, and then increased vacancy or non-payment of rent and stuff like that. So I'm starting to see a little bit of distress there, where it's like people going after some of these properties that, before it was like a multiple offer situation on that building. There'd be 10 offers and they're nitpicking the offer and asking, the sellers asking for buyers to, concessions and stuff like that. Now it's the exact opposite. These are just sitting. And then when I am seeing offers on these properties, they're like substantially below asking price. And so it's definitely like kind of shifted to a buyer's market from the investor standpoint. The one thing I would say, though, is just that tiny little quarter point rate drop that the Fed did. From an underwriting standpoint and a deal standpoint, I think it literally changes nothing. But I do start to see like an uptick of investors starting to they've just been sitting on the sidelines and they see that little decrease and they hear the talk of like the rates potentially continuing to go down. Well, they start getting back, they're asking, they're looking at deals and they're still maybe not penciling, especially if the numbers are asking, but there's at least, it's like starting to stir a little bit of movement there. And so I wish that the Fed would do like a 1% rate cut. You know what I mean? Like
Right.
that'd be the best thing in the world for me. So like in my, for me personally, I would really like that. I don't think it's realistic. And so I think we're going to continue to see these tiny little rate drops that really don't change anything from as far as like how the deals are, or they're not going to save these deals for people that are starting to go bad. I do think it's going to start to drum up some interest in the actual market with investors. And I would say the same thing is true for buyers. The problem is like right now, the nicer homes that like you guys build and the nicer homes that we would love to build, but we're not building right now, it's like the same thing. It's like it really isn't changing the economics of like how much that payment's going to be. We're seeing it a little bit with like first time home buyer type people. We're in the process right now. We should close a couple of weeks on, we're selling one of our rental properties to the tenants. They've wanted to buy for a long time and they've been waiting, and now they're kind of pulling the trigger and they're going to move forward with it. So we're starting to see a little bit of movement on that, like really lower end, kind of first time home buyer type end, but still not a lot on the upper end. How about you guys on this side?
Well, yeah. And you touched on something interesting there. Just to hit on the single side, we're not actively marketing any houses right now because we kind of we're in between developments. But one of the things that we've seen is just it's just spotty. Like I still talk to a lot of lenders, a lot of real estate agents, and for 2 weeks I'll hear, "Man, I think we turned a corner." Things have been flowing, flying off the shelves, and I see them a month later, and they're like, "Man, it hit a wall." And it stopped. And so we just keep getting spurts of sales here and there. It's kind of what we're seeing in our market. Nothing regular, but like you said, the quarter point really doesn't move anything for a home buyer, And so, but the thing that I think you touched on that is super important, and I don't know if everybody out there maybe understands the impact that investor capital has on the overall market. And so investor capital that's been flowing into real estate since 2010 as a good asset, an appreciating asset. And then obviously the flow of capital skyrocketed, through the first 2 years of COVID. And now that capital flow is kind of turned off, it has an outsized effect on that market. And so I think once that Fed rate does tick down, once those rates are a little more attractive to investors, you're going to see bigger and bigger players re-enter that market. And that capital flow is going to affect everything. It's going to affect the single family market. It's going to affect markets across the board. As we start to see that impact, I think that's what's really going to turn the tide. Because right now, there's not that big capital that you saw moving around for the last couple of years. And so you take that out of the market, it has a dramatic shift. And so as people start to get freed up from some of the bad deals they did in 2021, 2022, and they get either a return of capital, or even if they just get it off their books and say, "Hey, we're done with that, we're moving on," you're going to start to see the heavy deployment of capital again within these markets and others. And I think that's what's really going to make the impact. So I think what you're fighting consumer confidence on like an overall economic thing that we need to have buyers, to have renters. And I think that's super important. but then you're also fighting investor confidence for new projects, new deals, new big deals. And in both of our markets, whether we're building small deals or big deals, those big deals that investors are doing, that large national companies are doing, they're helping drive the market forward. They're helping drive the market up. And they help appreciation, rent, everything, because they've got to push it to hit their numbers. And right now, you're not seeing those projects move forward like you were in the last couple of years. And so once you see that investor capital, once you see those projects take off, that really helps the little guys, just because of the momentum that they're going to force, and they have the power to force. And so I think that's a really important thing where, from a consumer standpoint, a quarter point doesn't make a big difference. And it doesn't really from an investor standpoint either. But whereas 3/4 points on $1 million house maybe isn't that big of a deal, when you look at 3/4 points on a $100 million project, you start to get into really big money, and maybe things start to pencil again. And so I think that's an interesting thing that we're going to see, is when that capital starts to get deployed again and where they see the opportunities. And really seeing distress is a good thing from that standpoint, because if they do see distress, if they see opportunity, that money is going to start to move back into the market. And I think that's kind of what we're waiting and hoping for.
Yeah. Another thing that's worth mentioning, because you're talking about big money. So I think of in the single family, either build to rent, single family, just rental space, or small multifamily, is there's a lot of what I would call institutional players that have been heavy into real estate investing since 08, 09, in all markets. But we were at a conference, it was earlier this year, I think it was build to rent specific, but it showed a graph on how much they dialed back their investments in buying. So we're talking about the BlackRocks and these big institutional buyers where they own tens of thousands of houses or tens of thousands of apartment units. A lot of them have dialed back and have barely been buying. So they went from over 10% of the market transactions to, I think, 4 or less. And so, and especially where we're at in Central Arkansas, we had at one point a couple of years ago, we had 3, 4, 5, 6 of these big institutional buyers that were just sucking up homes as often as they get them. And so there was competition there for new, smaller investor, or smaller investors or regular investors just trying to buy houses, and first-time home buyers. So it's a lot of these first-time home buyers, because I had a friend that was I was trying to just help him buy a house. And it was he was getting bid out by these institutional buyers that were buying them for long-term rental properties. Basically, they've completely moved out of the market. They've been out of our market for a couple of years now. And when I say moved out, they've stopped buying. They still manage a bunch of properties here, and they would probably like to continue buying. But I think they're very smart, and they probably spend a ton of money, running data and actually digging into the numbers and having real reasons for doing this stuff. But they're waiting for that kind of bottom. And so as they think that we're hitting that bottom and we're going to start to come out of this and start to pick back up, one of my concerns, because it's going to affect us, is that they're going to swoop in and start buying again. We're seeing a decent amount of properties sitting on the market for a long time and things like that. But as soon as these guys come back and start buying again, it's going to put even more pressure on the market, and it's going to get real competitive real quick again, I think. So now I don't know when that's going to happen in Central Arkansas, for example, but I've got a good friend who's in Memphis, Tennessee, and it was the same thing. They all stopped buying, none more buying. But since, I would say in the last couple of months, there's at least 1 or 2 of them that are starting to buy again there. And so they must be thinking that it's got to the bottom, and they're starting to suck up houses again. And the issue is it gets competitive, because it's my friend that I was speaking with, he had a house that he was trying to sell, and he had basically a local company. So, and there was still a bigger investor, not a small investor, make an offer on a house. And the big institutional guy came in. They came in and offered, $6,000, $7,000, $8,000 more. And so of course we're going to sell it to that institutional buyer. So again, we're not seeing them back in the market here yet. But I think that could be coming pretty soon. So for people that are sitting on the sidelines, that are wanting to invest or wanting to buy, or they're investors, but they've been holding off for a long time. Right now, it's tougher than ever to make deals pencil and they work, but you probably have the best opportunity to negotiate right now, and the least amount of competition that I've seen probably since I've been doing this, as far as going out and buying deals. But again, it's probably just a matter of time before those guys re-enter the market in some of these places, and then it's going to get real competitive, because they'll come in and just say, "Hey, I want to make a all cash. We're going to offer 10% or 5% less than asking price, all cash, close in 2 weeks." And they'll hire agents and just be like, I want you to make an offer on every single house that's on the MLS. And so it's wild. Like when they come in and start buying, like they buy hard. So I'd be kind of curious to see how that hashes out with those guys.
And I think, yeah, again, kind of a little bit off topic, but it's an interesting debate with that because I think, especially in recent years, you've seen a big pushback to institutional buyers in markets, where people want to limit what they can buy or limit who can own a certain number of houses in a neighborhood or things
Yeah.
like that. And I think there certainly are concerns there with, larger companies controlling a decent amount of the supply, which they already do, in all honesty. But the other thing that I don't think people understand as much is how much they do move the market.
Yeah.
And so just the velocity of money, the amount of money that they're putting into these markets, if it goes away, it will have a dramatic effect. Will homes be more affordable? Potentially. Will they not appreciate as fast? Probably, without that capital moving around and without those transactions. And so it's an interesting situation we're in where, yeah, from a homeowner standpoint, I wouldn't like BlackRock to own half my neighborhood, but from an investor standpoint, what they're doing and forcing market appreciation, forcing velocity of capital, forcing all those things is helping markets. And I think that's what you're going to see help markets recover is capital returning to them. And so just an interesting debate that you hear a lot about today of people being against it and for it and what that really kind of means. But regardless of if you're for it or against it, it's going to continue. There's too much money to be made. They've got too much access to capital and they have to place it. And so, as long as there's opportunities to be had, it's going to continue to grow, especially I think the single family build to rent market is one of the hottest for them right now, but across multifamily, across everything, they're going to continue to push the boundaries.
So I think they really are interested in single family build to rent. Like I've seen that even a couple years ago when I started kind of paying closer attention to this. Um, it's really enticing to them, I think, just because of the scalability. But they've also, like I said, a lot of them have been paused, and so they're just kind of sitting on the sidelines. We're looking at that as a huge opportunity in the future, because again, when they do re-enter these markets and pick back up, that's probably one of the products that they're going to really be targeting to buy. And again, it's a lot of stuff, like you said, and it comes down to, I think we're heading towards a renter nation where most people want to rent. Like I said, we literally, like, we offer every one of our single family homes to the tenants. If they ever want to buy it, like, we'll sell it at fair market value. Like, we want them to make it home. And if they decide they want to be a homeowner, we want them to be able to buy it and continue to stay there. This is the first time it's ever happened to me. And so it's literally the first time I've had a tenant want to buy a house. And it's like, we're jumping through hoops to make sure they can do it and do it at a fair price and everything like that. It's just not common. Like, a lot of people just want to rent. And so there's going to be more of a demand. The one upside, I mean, I know a lot of people hate on these big Black Rocks, and it makes it harder for me because it's like we're competing with them and we can't compete with them. They've got, cheaper access to capital and much larger and everything like that. But I mean, some of these guys were buying 60 rundown houses in Central Arkansas a month. And then they were paying very well to have them rehabbed. And so, like, you look at the just the local velocity of money that's turning through when all that was going on. I mean, all these again, it makes it harder for me because it's like the construction crews, they'd rather go work for them because there's so much more, it's so fast and there's a lot of money there. But a lot of those guys were making really good money, and the material suppliers and everybody was selling materials and the labor to do it. And so it was good for the local economy, at least, to have that. Plus, they was fixing up some of these neighborhoods that were really blighted and needed that money being injected into it. But again, they're at least as far as I know, none of them are here buying right now. So it'll be interesting to see if they've picked back up in Memphis. I have a feeling it'll probably be heading this way pretty soon here.
Yeah, I haven't heard that about Memphis. I think that's a great sign. And I think really the next 6 months are going to tell us a lot. And I think especially in our markets, call it the Sun Belt or whatever you want to call our general area of the country. I think what we've normally seen in times like this, which again, in economics, nothing ever really repeats itself. But we've seen that we're a little later to go into whatever it is, a slow sales, a slow rent, whatever it is. We're a little later in, and we're usually the first out. And so if we're seeing movement in Memphis, hopefully that's a good sign. And hopefully we'll be able to do a market update, next quarter or something like that and we'll be able to say, hey, we're seeing movement on the other side, because traditionally that's what's happened is it's been a little delayed to hit us. And it always usually makes you think, hey, we're going to escape unscathed this time. It's not going to make it here. It usually does. But we're usually one of the first ones out. And so hopefully that's what's going to repeat here is that, we start to see rent appreciate. We start to see supply really drop because of absorption rates, both in single and multi. And then, prices are going to go up, rents are going to go up. And it could have a pretty dramatic swing here, is what we hope in the next 6 months.
Yeah, absolutely. Cool. As we wrap this up, any takeaways? I mean, maybe any advice to people that are either in business where they're running businesses, or even if it's just people that are listening that are working a regular job but maybe feeling the squeeze of some of this stuff as well.
Yeah, I mean, I think two different pieces of advice. I think, from a business standpoint, I think there is always, and we get into it, we always think this stuff is never going to happen. We always think rents are going to continue to grow, or, you trick your mind into thinking the good times are going to roll. And they're not. And so just preparing for that, whether it's from an employee standpoint, from a balance sheet standpoint, just making sure that you're aware that the economics are cyclical. We're going to have these times, especially in the construction industry. And so I think from a business standpoint, it's just, you always want to have at least one person on your team who's going to be a realist about this stuff and say, hey, well, what if this doesn't work out? What if this doesn't happen? And so I think from a business perspective, that's something to keep in mind. But from a personal perspective, now's the time to be aggressive. I can't remember the Warren Buffett quote off the top of my head, but basically, don't follow the crowd. Be aggressive when everybody else is being timid. And we're hearing from our Chase and I's conversation that everybody is being timid. The big boys aren't buying right now. The market's soft, but man, there are opportunities to be had. So whether it's buying your first house, whether it's looking at a rental property, you got to find the right agent who's willing to make offers that people might find insulting sometimes, but now's the time to do that stuff. Now's the time where people they're in a bad situation, and you can help solve that problem for them. And so I think a lot of times buyers go away when the market's down, which is counterintuitive because it's the best time to buy. And so I would just look at the opportunities that are out there and how can you take advantage of the situation, knowing that in the aggregate, you're going to make money in the long term. Even if, and I think people get stuck on, hey, where's bottom? What if the house decreases 5% over the next year? You're fine. That's not a big deal, but it increasing 25% over the next 5 years, which is probably way more of a certainty, that's what you're looking at. And so don't worry about finding bottom, just worry about finding a deal that works. And so that's what I'd encourage people to do.
Yeah, that's great. I think for me, on both sides, so personal and business, but I'll start with the business. I think it's just really digging in and like using this time right now to just continue to get better and hone in. And like, for us, it's like we're underwriting deals a little bit harder, like internally. And then one thing we came up with recently is like re-underwriting deals. So a lot of times we'll underwrite a deal and it's like 6 months later we close the construction loan. And so one thing we found is like as we start to adjust for some of these rent concessions and stuff like that, maybe that deal doesn't pencil anymore. And so now's the time, instead of getting in over our skis, to pump the brakes and make sure that whatever we're doing makes sense, and then just getting better. I mean, really pushing on systems and processes and building the team and getting in front of, like, if we've got customers that maybe they're having a hard time, getting in front of that so that it's not going to negatively affect us as a business. And again, there's going to continue to be, like, I think right now, I think it's Warren Buffett, the quote you mentioned is be fearful when other people are greedy and be greedy when other people are fearful. So like you said, nobody's, the building slowed way down, the buying slowed way down, like nobody's doing anything. So it's like digging into that and seeing there's still opportunity here, and where's that opportunity going to be, and then trying to get in front of it so that as we come out of this, like we're already rolling in a good financial position, and we've already got projects on the books or rolling, and we're going to be in a really good spot when that starts to take off. And then I think the same thing is on the personal side. Like I think whether you're a business owner or you're an employee or whatever, or you're just getting out of school, like right now is a really good time to like dig in kind of in all aspects of your life and really just focus on controlling what you can actually control. So like if you're getting less hours at work, like you may not be able to control that, but how can you become better, like a better employee or a better future employee? They work on stuff like fitness and your faith and your family and things like that. And really spend the time right now to really dig in on that stuff. Because again, it may be hard right now, but as you start to come out of that, you're almost going to have like a jump start on the people that are so, woe is me, I lost my job, or I'm not getting as many hours at work. Like I think right now is the time to dig in and really push on that stuff. It's a good opportunity to do that.
I love it. That's a great point.
Cool. Well, thank you guys for listening. And again, we'd love it if you subscribe to our channel and liked and shared what we're putting out there. If you have any questions or comments about what we're discussing, please leave it in the comments or send us a message, and we'll try to touch on it if we can. And then we'll see you guys next time.
See y'all.